Scholars, today we are going to talk about chapter 1. What I am going to do in this chapter, I am going to post the lecture video in which we're going to talk about the concept for chapter 1, accounting in business environment. And in the next video, you would be able to see a numerical example that I have solved for you. So in this the lecture video, we're only going to talk about chapter number 1 and all the theoretical concept, because in the chapter 1, 2, and 3 you will find it is heavy on theory, and this theory is very important for the students of accounting to understand, so they can see what a business is and what accounting does for a business. So let's start. So the first question is, what is a business, or what is a business? So an organization or entity engaged in commercial, industrial, or professional activities. All right. So what kind of activities we are talking about, right? So it could be commercial, industrial, professional. So industrial, such as Ford Motor Company. Professionals such as engineering company or an accounting company or a law firm that's providing you professional service. Commercial enterprise such as retail or wholesale, we can think of in terms of Sam's Club or Walmart. So these are activity. But why these industry or these entities are in business? They are in the business of making profit. So when we are talking about profit, where this profit comes from, this is our goal. It's a goal of these all of these entities is to make profit. And a very simple definition of a profit is when revenue is greater than expense. That gives you a profit. So revenue is greater than means you make $20 in revenue today and your expense was $8. So today's profit was $12. But what if the revenue is less than expenses? That will give you a loss. There will be no profit, it will be loss. For example, you made $10 of revenue, but you have $15 of expense, so you have a $5 of a loss. So remember, these organization or an entity that we are talking about, these are for profit. So a business means an entity that engages in whatever activity to make profit. The term business also referred as organized effort and activities of individuals to produce and sell goods and services for profit. So basically, we either produce goods, we sell goods, and we sell also our services. So remember, there are only two kinds of businesses. So there are two kinds of businesses that we talked about. One is product and the other is service. So there are two business. That's what we do. So now that you have an idea what a business is and why business exists, let's check out what is accounting. Accounting is a process. It's a process of recording and this reporting. Okay. So accounting is a process of recording, which is this, and reporting. So these are two very important jobs of accounting: recording and reporting. So what does it mean by recording? For example, today you sell $1,000 worth of your product. So we need to record what happened to these $1,000 of product. First, we have to record that did we receive a cash, which is the customer gives us to receive our products. So if the customer has given us a cash, so we have to make sure we make a recording that the cash has increased by $1,000. And we have to also let in accounting know why this $1,000 is coming in the business. So we're going to make a second entry and say, second recording that because we sold $1,000 worth of our product. So that's one thing. Now we also have to make a recording that our product, say you are selling pastries, so your pastries are gone down, say by 100. So you sell every pastry for $10, so 100 pastries are gone. So you also make a record that your pastries has gone, which is basically your is gone. So we have to make this. And then what was in the pastries, we also have to make sure that goes down as well with it. So that is the idea of recording. What is reporting? We're going to sum up of all the recordings of a month or a quarter or a year, and we're going to put them in a report. I'm going to give you more information regarding it. So these are the transactions. So what we record transactions. And a summary of these transactions is called reporting. So individual transactions get recorded and a summary of transactions get reported in the form of financial statements. What are these financial statements? We're going to talk about a little bit later in this lecture. So just bear with me. So why is accounting important? Because accounting is the information system, a system that keeps track of the information, measures business activity, means how much you are selling, how much you are buying, how much you are borrowing, how much you are lending, how much you are paying, how much you are receiving, hiring, firing, all of those things is a part of the business activity. And process this information into reports. Again, the report simply means financial statements that we are going to talk about. Another thing that people talk about accounting is the language of business. What we are talking about, there are so many different kinds of business, whether you are making Ford cars, you making pharmaceuticals, you are opening a bank, you have an insurance company, you have a retail, whether it means Target, Walmart, wholesale such as Sam's Club and Costco, and construction companies, engineering companies, legal law firms, accounting firms. All of those businesses needs accounting because all of these businesses are involved some kind of business activity that needs to be recorded on a daily basis. And once we record these things, we have to process the information into reports, which we call financial reports. That's a summary of all the recordings or all the activities. So accounting is used to do this in every business. So for example, today you're working for a bank and then 2 years down the road you move to a company, say Walmart. You will notice that 99% of the accounting that you have used in bank is the same as in bank, same as in Walmart, same as in the Ford Motor Company, same as an Exxon Mobil, and same as you are working for a pharmaceutical company, same mark. So all of those accounting will be the same. And we will learn a little bit more a little bit later that how they. So a financial statement are the business documents, of course, companies use to report the results. So it's very much like today you are taking this course accounting, and I'm sure for a full-time student you may be taking 2, 3 or 4 additional courses. In every course you are required to do certain assignments, and at the end you will receive grade for each assignment throughout the semester, and at the end of the semester you will get a grade. And then maybe a week or two later you will receive either online or in mail a piece of paper that reflects how many grades, how many courses you took, what grades you have, and what is your GPA. So that will be a result of your activities throughout the semester. And at the end of the degree plan, or at the end of the at graduation, you will receive a transcript that shows grades for each course that you have taken in your 4-year, 2-year, or master's degree. All right. So these groups can include managers, investors, creditors, and regulatory agencies. So managers needs to evaluate the performance. For example, how well we did this week, or this month, or this quarter, or a year. Investors evaluate this performance because whether they want to invest in your firm or not, buying stocks. Creditors evaluate because they want to know whether they want to let you borrow more money or not. Regulatory agencies, it could be IRS, it could be state agency, it could be EPA, it could be OSHA. All of these regulatory agencies wants to know how is your business doing, because for example you are collecting sales tax for the sales tax department in the state of Texas, or you are paying your payroll taxes of your employees for federal reporting IRS, or you at the end of the year, did you pay the tax on the income that you have generated. In turn, these parties use the reported information to make a variety of decisions, such as whether to invest loan to the company. So you understand, okay. So accounting is an information system that measures business activities, again we have talked about earlier, process the reports, data reports, which we call financial statements, and then communicate results to the decision makers. Decision makers are inside the business and outside the business. Inside the business are managers, and you can say shareholders. And outside are your bank, insurance companies, government, all of those people are potential investors or creditors, investors, future investors that they want to invest in your company. All right. Then we're going to talk about accounting process, measuring accounting activity of an entity in monetary terms. What is monetary? This is important. This means in dollar. Monetary simply means in dollars, means I have sold $1,000 worth of merchandise. My revenue is $1,000. My inventory is down by 1,000 because. Identify the relevant economic activity, what business we are in, and quantify these activities. Quantify means we have to put them in numbers like 1, 2, 3, 4. Quantifying it. 1 kilo, 2 kilometers, $1,000 things, and record the results in financial statements. Okay, who uses accounting information? We have already talked about individuals who are interested in, sometimes even customers read this statement as well, even though they are neither a creditor nor an investor. Employees do read it. Why employees read it? Employees wants to know how well this company is doing. Do I need to jump the ship, find another job, or should I continue with this company? Should I invest in my own company stocks or not? Investors, creditors, already explained to you. Regulatory bodies, non-profit organization. Why non-profit organizations such as March of Dimes and American Heart Association is interested? Because if Ford Motor Company is doing well, these non-profit organizations such as March of Dimes or Salvation Army can go to them for their donations. So that's the reason we do this. The next thing is external user and internal users. Internal users are management, needs to know the profitability of each division, all right, or a store or product line, if you want to be more specific. All right, so for example, product line, Apple company has many products. They want to know what is the profitability of each product. Or a store, thousands of a store, is all the stores are doing better. or is there some stores that are lagging behind and how we can improve their performance. Finance department needs to know if there is enough cash to pay its short-term expenses. We're going to talk about these short-term expenses and short-term liabilities in a minute. Human resource needs to know the effect of 4% of all employees. 4% is just an example. So what we need to know, the effect of 4% for all employees means if we have increased their salary by 4%, or if we are giving them 4% bonus based on their base salary, how is it going to impact the cash, for example. The external users are investors, creditors, and regulators we have already discussed. The next thing we're going to talk about is there's two kinds of accounting: financial accounting that you are taking this semester, and managerial accounting you probably need to take in the next semester. So what is the difference? This financial accounting provides external decision makers, investors, creditors, and government agencies. It is an extremely important piece of information because all of these stakeholders are making their decision based on the financial statements that you are putting outside. So financial accounting provides information for external as well as for internal decision maker. But usually it is considered for external decision maker. However, internal decision makers also use this information. Managerial accounting, on the other hand, provides only for internal decision. This information never goes out to external decision makers. You may find this piece of information that I'm about to give you in later accounting courses, that sometimes when auditor comes, external auditors, because auditors are also two kinds of external auditors and internal auditors. So when an external auditor comes, they also sometimes ask to see these managerial accounting that you have used for internal decision maker, such as managers, employees, individual business within and outside the entity. So it's very rare the outside entity that we are talking about, they are maybe have a stake in the business. Say for example, one company A owns 20% of company B, so then company B becomes an investors and they may want to see it as well. And these things are their budgets, forecast, and projections. We're going to talk about all these three things in a lot of detail in the managerial accounting, because this course is all about financial accounting. So we're going to keep our emphasis on financial accounting. There are types of accountant, then these are CPAs. CPA is a public accountant, certified public accountant we call them. And these accountants work in a lot of different areas, and it requires a certain number of accounting courses plus business courses plus passing 4 part of exam to get a CPA title. If you ever interested in getting a CPA, shoot me an email. I will provide you more information. CMA, or certified management account, they specialize in accounting and financial management knowledge, but this CMA, most of them are doing these jobs: budget, forecast, and projection. These CMAs work with CPAs, but they have a very distinct job, basically doing these three things: budgeting, forecasting, and projections for the business. Accounting positions, they are in public, such as you become an external auditor. Privately, you work as an accountant for various companies. So in private, you work for Walmart or ExxonMobil or Ford Motor Company. Governmental accounting, yes, it is an extremely important part of accounting. Government entities, there are many government entities. So federal government is one entity. Then federal government has so many other departments. They need accountants, like Pentagon, a State Department, Department of Education, Department of Commerce. Then we have like state government in Austin. So for example, the state government has its own accounting department. Then comes counties. For example, Collin County has its own accounting department. Then Collin County has, say, a city of Plano. City of Plano has its own accounting department. So every level of government needs an accounting. And non-profit I have already given you, like American Heart Association, March of Dimes, Salvation Army. All of those companies also keep. So basically, if you look for accounting positions, you will find them in public accounting, private, governmental, and non-for-profit. A lot of people like to work in non-profit and governmental. The good thing about governmental non-profit is they are very good jobs, they pay well, and people usually don't work more than 40-45 hours a week. Weekends, it's very, very rare to hear from somebody who works for government, a non-profit, that they work on weekends, and they have a very good other benefits as well. Public and private accounting jobs, anywhere cost you 60 to 70 hours a week, including working on weekends and late in the evenings. All right, so I'm not trying to scare you. You will learn more about these jobs as you going on your pursuit of getting a 4-year college degree, if you choose to do in accounting. All right, so we're going to talk about here a professional framework. How is accounting work? So accounting has rules. I'm just using it's a framework of rules. So basically it's a framework of rules, and this is called GAAP, generally accepted accounting principle. So generally accepted accounting principle guides every accountant, whether you are in private, public, government, and non-profit. It basically guides you how you're going to record each transaction and how you're going to provide a reporting of the summary of these transactions. So these rules is created by a group. It's called Financial Accounting Standard Board. All right, so Financial Accounting Standard Board has a job to update, modify, and create new generally accepted accounting principles so the accountant can do their job. A guide to action that can and does change over time. As I said, keep changing. Differ among countries, yes, it changes. So I want you to keep in mind there is a Financial Accounting Standard Board that make or create or modify or change rules. It's called GAAP, or generally accepted accounting principles, and the entire recording and reporting of transactions in accounting follows the GAAP framework. Okay. Similar to GAAP in other countries outside United States, we have International Financial Reporting and Standards, IFRS, and just like FASB, they have IASB that makes international financial reporting rules. And these are the things. Approximately 220 countries in the world follow IFRS, and there are some American or US companies who basically provide the summary of their financial transactions in the name of financial statements, both in GAAP as well as under IFRS. All right, so governing organization. So we have Financial Accounting Oversight. This is US Securities and Exchange Commission. So I am going to stop here and tell you that there are two kinds of companies, and we will discuss this in later in the course again. One is called public and the other is private. What is the difference? Public companies is the companies, their shares, people buy and sell their shares on an open market such as New York Stock Exchange. So these are publicly traded companies. Private companies are the companies, their shares are not sale in open stock exchange such as New York Stock Exchange. So SEC, Securities and Exchange Commission, keep an eye only on public companies, not on private companies. So Financial Accounting Standard Board that we talked about earlier oversee creation and governance of accounting standards, report to the Security and Exchange Commission. So Security and Exchange Commission is sitting over here on the top. They report, FSB report to SEC, and also makes GAAP rules for accountants. SEC oversees the financial market. So the entire market, when we are talking about market, we're talking about all the companies. So there are 30 companies in Dow Jones Industrial Average. There are S&P 500, S&P 100. All those company forms financial markets. Every company that has stocks trading in public is called the publicly traded company. The GAAP that we have used in the United States is called US GAAP. FASB has codified how GAAP is organized and communicated. Communicated to who? The people who are using GAAP. Okay. And the Public Company Accounting Oversight Board, PCAOB, approves auditing standards known as Generally Accepted Auditing Standards. So we have, this one was created around 2001, 2002. And ethics in accounting and business, and audit is an examination of company's financial statement and records. So what an audit? So every publicly traded company, according to a Public Company Accounting Oversight Board, has to go through a yearly audit, and that audit is done by an external auditor. And you will get more information about this in the course audit if you become an accounting major. Why is needed? Because company financial statements are prepared by companies' employees, accountants. They can be CPAs or not CPAs, but somebody from the outside to verify on behalf of a public. So that's why they are called public accountants. The CPAs are external auditors who are doing a job for the public. So public knows these financial statements are true. The Sarbanes-Oxley Act requires company to review internal controls. When we go to chapter of the internal control, we're going to talk about this topic in detail. Now we're going to talk about what are the organization and rules that govern accounting. Accounting guidelines in the US are called Generally Accepted Accounting Principle. These are the qualitative characteristics of these GAAP issues. So useful in accounting information must contribute to the decision usefulness. All right. So what is useful? Useful is defined by the person who is reading that information. So for example, if you want to invest in a company A, you want to know everything about the company, because if you do not know, you could make either of the two decisions. Either you invest and lose the money, or if the company was good and that information was not provided, you missed an investment opportunity. So the information useful account must contribute to the decision of usefulness, means to help the decision maker make the best decision for himself or for his firm. Relevance. Contribute to the predictive and evaluative decision, allowing user to make a decision. Means contribute to the predictive and evaluative decisions. Means it helps you. This information is relevant. Means you need to take into consideration this information in your decision making to make the best decision. What is the opposite of relevance? Is irrelevant. If this something is irrelevant, you're not going to pay attention. But if something is relevant in your decision making, you're definitely going to make. For example, if College does not tell you that, say, next semester, they're going to double your tuition fees. They are not planning to do that. I'm just using as an exaggerated example here, that in this way, and that you do not know, you may come to join college for the next 2 years. But if you already know it, then you either may come to college or will go somewhere else which is cheaper for you. Faithful representation, complete, neutral, free from error, and verifiable. Faithful representation means when you providing this information to internal or external stakeholder, the information is complete, you didn't leave anything behind. Neutral is basically unbiased, means your biasness is not involved. Free from error means you did not make any error in making this information. And also it's verifiable, means you have proof or you have paperwork or you have everything to prove what the information that you have provided is correct. Disclosures required to the notes of financial statement of chosen accounting policies. Disclosures are things that you provide in footnotes to the financial statement in case if the reader either misconstrued the information or completely misunderstood or do not understand at all what it is. So you make sure you provide disclosure information in the footnotes. Say, well, this piece of information or this number that we have used here, it is because of this reason, or we believe this is going to happen, or we have done something that could impact next year profitability. Verifiability, different individuals could reach the same conclusion. For example, you claim your height is 6 feet. 6 people go out and measure your height. The average is 6, but some people saying you are 5'11", some saying you are 5'11 and a half, some saying you are 6 feet and 1 inch, some are saying you are 6.5 inch, you are some saying 6.25 inch. But we can verify on average you are 6 feet, but 6 people are getting. But in accounting, we make sure that when 6 different people, they have no connection whatsoever, reading this information should come up with the same decision whether they want to invest in your company or not. All right. The next thing is recognition and measurement. When we are talking about recognition and measurement, so the conditions under a particular asset, liability, revenue, or expense. So I'm going to tell you one thing. There are 3 or 4 very important accounts in accounting. So one of them is asset, liability, revenue, and expense. These are the 4 accounts. These are extremely important, and we are going to talk about over and over again in this course. So make sure you familiarize yourself. What is an asset? What is a liability? What is a revenue? What is an expense? When we recognize it, and how we measure it. All right. So these are the things that we're going to talk about, how and when we're going to recognize it, and how we're going to measure it. Concepts: accounting entity, just a business. Any business is an accounting activity. Accounting period, it could be a month, 1 month, 1 quarter, like 3 months. It could be a 6 months period, or half yearly, or semi-annual, or it could be yearly. The most important are yearly, quarterly, and monthly. Majority of the companies provide this information on a monthly basis, quarterly basis, or yearly basis. Monetary unit in this country is a dollar. Going concern simply means the business will be able to continue for at least 1 year. Going concern, going means continue. Concern means will or will not. So going concern can provide you it will or it will not continue. So you have to provide this. The going concern information usually comes from the external auditor. What are the principles? cost principle. Cost principle simply means that we are going to list our asset at the cost and liabilities at the cost we have paid for it. For example, you purchase a factory. The land was $50,000. So you're going to say land is $50,000, building was $200,000, and $100,000 was for the machinery. Revenue recognition, how much and when we're going to recognize the revenue, and how much revenue are we going to recognize it. We're going to talk about a little bit later in more detail. Expense recognition is the same thing. How much matching principle is, we're going to talk about in a minute as well. How much and when, how much expense we're going to recognize and when we're going to recognize. Full disclosure means you're going to provide any or all information related to the information that you have provided in numbers in the so you provided in the quantitative format. Now you have provide a qualitative format as well. So entity assumption and organization stands apart from other organization and individual as a separate economic entity such as sole proprietorship, partnership, corporation, LLC. Like I said, it's just a business, any business. Going concern entity will continue to operate for the foreseeable future, and the foreseeable future in the United States, it's 1 year. Historical cost principle or cost principle is the same thing. These two are same. Assets should be recorded at the actual cost on the date of purchase. That's all you need to know about. And we will continue to visit these assumptions and principles and concepts every chapter. A stable monetary unit that we talk about, assume dollar. So we are in the United States, we're going to use our dollar. Is stable over time. I mean, a business is not responsible whether it is stable or not. The business job is to report their information using the dollar. If they, for example, Ford Motor Company wants to report their operations in, say, in Europe, so they can use euro. But for United States readers, they have to provide this into dollar. How many billions they have invest, how many billions they have made, and what millions of profits they make. It should all come into dollar. So we're going to talk about various forms of business. So how many different kinds of entity? We have sole proprietors, like a small business, mom and pop shop, such as for example, a laundry shop, a coffee shop, or ice cream shop. A business owned by one person. Tend to be small retail store or solo, provides financial services, for example, a doctor's clinic, but usually they do not do sole proprietorship. They usually use LLC, and it is one of the most common form of business. Advantage is easy to form. There is a tax advantage because when we go to corporation, you will see corporation pay tax twice, but proprietor pay tax just one time, and we'll explain to you why. Owner control. So you have 100% control over the business, hiring, firing, buying, selling, borrowing, lending, in everything. You are fully in control. Personally disadvantaged, you are personally liable for all business debts. For example, you are running a coffee shop, you file bankruptcy, everything is on the line. Your home, your clothes, your shoes, everything you can lose everything. Partnership. A partnership is a voluntary association of two or more people. Means you and your friend decides to open a plumbing company, for example. In a partnership, income and losses flow through the partners. Means partnership do not pay any tax. They calculate the income or losses. So for example, your plumbing company got $50,000 profit this year. So $25,000 will go to you and $25,000 go to your partner. And when you file your tax return stamp 40 at the end of the year, you will mention in it that in my business, I am a partner, I make $25,000, and that's how your income will be taxed. But partnership itself will not pay a tax. And then we are talking about many small firms or medium-sized companies. General partnership have a mutual agency and unlimited liability. You don't have to worry about your question. Advantage is relatively easy to form, and tax advantage because you don't have to pay tax twice like corporation. Limited liability company, business, not owners is liable for debt. So for example, you open LLC for your accounting firm and you have a loss, only the business is responsible for the debts. They're not going to come after the owners. In limited liability partnership, only liable to up to investment put in. So for example, you open an LLC for any business and you invest $10,000. You can only lose up to $10,000, no more than that. May have one owner or many, and they are called members. Members have limited liability. Income flows to the member just like in a partnership. Income goes to, so if somebody is a 10% owner, they will get 10% of the profit, and if someone is 40% of the owner of the company, they will get a 40% of the profit. Corporation is a total different thing. It's a separate legal entity. It has its name, address, phone number, fax number, all that thing. It has a continuous life, means if the owner dies, it will continue. Corporation has shares. Shares simply indicate or indicative of an ownership. So you can either gift somebody that share, or you can sell it, or you can buy it. Limited liability for stockholders. For example, you purchase $20,000 worth of shares in Walmart, and Walmart filed bankruptcy. As a shareholder, the most you can lose is $20,000. Stockholders elects boards of director, which sets policy and appoint officers. So for example, here are all the shareholders. They elect board of directors, which are anywhere 15 to 20 of them. Board of director hire all the C-suite people, CEO, CFO, CIO, COO. They hire these people, and then these people hire the mid-level management and continue like this. And the shareholders are basically the owner, and these board of directors are basically representative of owners, and these people are employee. So board of directors and shareholders are considered principal, and these people are agent. So when they say no mutual agency, means these agents work for the principal, not the other way around. So there is no mutuality. Over here in sole proprietorship, you are the principal and you are the agent. Advantage is easier to raise capital, easier to transfer ownership. Protection for the stockholders, again, personal liability means you are not liable. For example, if I go to Walmart and slip and break my hip, only Walmart as a corporation is responsible. Their shareholders are not responsible. Stockholders has no personal obligation for the personal corporation debt. For example, Walmart borrows $1 billion and they fail to pay. They're not going to come after you because you own shares of Walmart. Disadvantage, double taxation. What does taxation means? Corporate has to pay income tax on their income or profit, but once they distribute this profit in the name of dividends, then the shareholder who are going to receive dividend, they have to pay tax again, because dividend is considered income, albeit a passive income, but they consider a income, therefore they have to pay. So that's why double taxation you don't see in anywhere else. Okay, in our next so this is basically an introduction of accounting, framework, legal issues, principles, and what different kinds of accountings. And the most important thing that we're going to talk about is the accounting equation, which is asset is equal to liabilities plus equity. So assets so what is an asset? An asset is something that is going to provide you future benefit. For example, suppose you are a tall person, your height is 6 feet, so you will receive the benefit of being 6 feet for the rest of your life in your personal endeavors and maybe in your professional endeavors, that you will be liked by other people who think that 6-foot person is a very good looking person. Or maybe you have very nice hair, so you will get benefit of having a very nice set of hair. Or you are very athletic, so you would look good, you look great. So so your looks, your body, your height is an asset, because the definition of asset is going to provide you future benefits. There are two types of assets: current assets and long-term asset. Current asset has a life of less than 1 year. Long-term asset has a life of greater than 1 year. So current assets are like cash and cash equivalent, short-term investments, accounts receivable, and prepaid expenses. Long-term assets are property, plant, and equipment such as land, building, machines. Long-term investments, intangible assets such as royalty, trademarks, and things like that. Liability is that debt, something you owe or something business owe. Right? So liabilities also comes in two forms: current liabilities and long-term liabilities. Current liabilities simply means they are due within a year. Long-term liabilities that they are due in after 1 year or longer than 1 year. So current liabilities are accounts payable, salaries payable, short-term notes payable, accrued liabilities. Long-term liabilities are usually called long-term notes payable, bonds payable, and leases. Under equity, we have represent stockholder ownership of the assets. So basically, if you see this thing, equity is equal to asset minus liability. So if you sell all your asset and pay off all the liabilities, and whatever left is your equity. So for example, suppose your parents own a house and the price of the house, sale price of the house is $500,000, but they owe, for example, to bank, so they owe $200,000. So they have to pay, if they sell for $500,000, they have to pay this $200,000 to bank. So the equity they have in the house is $300,000. So equity simply means what the owners in the business own, how much they own. So equity consists of so the equity accounts are like common stock, additional paid-in capital, retained earnings, treasury stocks, accumulate other comprehensive income. Don't worry about it. If you do not know, there is an entire chapter for equity. There are, I believe, 2 chapters on liability. There are multiple chapters on assets. So we're going to talk about all of those things in the next few lectures. Equity consists of contributed capital, comes from shareholders, also called paid-in capital. Contributed capital is the amount invested in the corporation by owners or shareholders. And common stock represent the basic owners of every corporation. Retained earning is basically your profits that you have, the company is accumulated or retaining in the business. This is again an excellent important piece of information. What is a transaction? A transaction is any event that affects the financial position of the business and can be measured with faithful representation. A transaction, example of a transaction. A business is purchasing a computer. So what is coming into the business? A computer. The next thing is important. How a business is paying for that computer. Are they paying cash? Are they promising to pay 15 days later? Are they promising to pay a month later or a year later? So that is very important. So as an accountant, you must know whether a transaction needs to be recorded and when to be recorded and how to be recorded. So these are very important things. There are certain transactions they do not need to be recorded, and we will talk about those transactions as well. Financial statements are business documents that are used to communicate information needed to make business decisions. And these financial statements are income statement, balance sheet, and a statement of retained earning, and a statement of cash flow. And we're going to talk about all of those things in a minute. What is a balance sheet? Reported at a point in time means it's a snapshot. You can take that snapshot at the end of the month, and at the end of the quarter, end of the 6 months, or end of the year. And on this date, as of December, it's always say as of December 31st, the company has that many assets, liability, and equity. List the firm's assets, liabilities, and stockholders' equity. So the balance sheet provides you information about assets, liabilities, and equity. Remember, balance sheet does not provide you information about revenue and expense. That goes into the income statement. All right. Assets are the firm's resources that provide future benefits. Liabilities are the obligation, the things that you owe to others. And stockholders' equity represent stockholders' claim on the assets of the firm. Like I said, once you sell all the assets and pay off all the liabilities, whatever left is your stockholders' equity. Income statement report the results of operations, means revenue and expense. Operation simply means how much you have sold and how much you have incurred an expense of a given period of time, means a month, like 1/1 to 1/31st, or like from January to March, like a quarter, or from 1/1 to December 31st for the whole year. So a period is important concept in accounting. It could be a month, a quarter, a 6 months period, or a 12-month period. It reports revenue and expenses. Revenues are increase in company resources from providing goods or services. Means if you are selling your legal services, it's going to bring your revenue. It will increase your revenue. Expenses are decreased in revenue from providing. For example, you're a lawyer, you have a legal firm, you have to pay rent, you have to pay the utilities, you have to pay for the internet, you have to pay for your legal clerks, you have to pay for the receptionist, you may have to pay for the rent, or you may have to pay for insurance. As a lawyer, as a doctor, you also carry insurance. All right. A statement of stockholders' equity reports the events causing the increase or decrease in stockholders' equity during a given period of time. All right. Reports company's retained earning from beginning to the end of the period. Consider of two parts: contributed capital and earned capital. Earned capital is basically retained earnings. This is common stock and additional paid-in capital, which is capital contributed by the stockholders. Earned capital is earned by the company and reinvested rather than distributed back to the stockholders. Dividend always comes from retained earning. If you are not paying dividend, that means you are investing all the profit in the company. Some companies have a separate statement of retained earning, but most include retained earning as part of the stockholder equity. I will show you that how to make a statement of retained earning using the information based on income statement and balance sheet, and then we'll go from there. A statement of cash flows, it talks about how much cash come and how much cash go out during a given period of time. So we want to see the change in cash. So we look for this. It has three parts: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Operating activities simply means the operations of the company. Investing means buying long-term or selling long-term assets. Cash flow from financing is basically how much you borrowed, how much you paid off, and how many shares you have sold or purchased back. All right. All of these things will be repeated again in the future chapters. So if you don't understand anything, don't feel that If you want to read this again, perfect. If you want to watch this again over a time period, perfectly fine. Remember one thing, I didn't learn accounting in one try. It took me a while. I have been studying accounting for the last 20 years. All right, relationship among a statement. Net income from the income statement is used to compute ending retained earnings on the statement of retained earning. All right, we will show you there is with a picture. Ending common stock, retained earnings, and total equity from the statement of stockholder equity is shown on the balance sheet. The ending cash balance on the statement of cash flow is shown on the balance sheet. The beginning period of balance sheet shows the company financial position at the end of the year. The income statement, statement of stockholders' equity, and statement of cash flow reports activity for a period of time. The end of period balance sheet reports the company financial period at this later point in time. Let's put everything together in a simple form. This is your income statement. It gives you put all the revenue, you minus all the expenses, that gives you your profit. All right, so this is your profit. Then a statement of retained earnings, I'm just putting RE, it has beginning balance of retained earning, which is beginning of the year on January 1st, say it was $100, and then you add your profit, which is, some people call net income, and you say you have like $30. Then you pay dividend, say for $40, right? So your ending balance of retained earning on December 31st will be 100 plus 30 is 130 minus 40 is 90. So that is your ending balance. Your balance sheet will look like this. You have all the assets, you have all the liabilities. So asset has current assets and long-term assets, current liabilities and long-term liabilities, and then you have equity. In the equity, you have common stock, preferred stock, additional paid-in capital, and retained earning. And that retained earning will be listed here. So for example, the net income that I have created 30. So suppose your revenue was 100 and your expenses was 70, your profit. So this information goes over here, and then this information goes over here. So this way you can see that your income statements provide the profit and net income, goes to the statement of retained earning, $30. That gives you the ending balance, and it's listed over here. And the balance sheet is as of December 31st, but income statement is from 1/1 to December 31st, January 1st. And the same thing is state of retained earning is from 1/1 to December 31st. Okay, I hope that helps you. And then we're going to talk about the last thing, management decision and analysis. It is an important part of the financial statement, and usually it goes on the first page of the financial statement. Management's interpretation of the company's recent performance and financial condition. Basically, it's a sort of a summary that management provides with the numbers, that what we have done and what we are going to do in the future. Notes to the financial statement, usually at the end, contains information about assumptions, estimates, measurement procedures, and details behind summary numbers. So there could be any assumption or estimate, they will provide you. Auditor reports containing opinion about financial statements. So the auditor is going to tell you whether they got A, B, C, or D in the financial statement, and then you can make a decision based on financial reporting objectives. What are the objectives of providing a financial statement. It must be useful in making financial decisions. It must be helpful in assessing the ability of a company to generate future cash flow so they can pay tax, interest, dividends, and things like that. Provide information about a company's economic resources and claim on those resources. Basically, the health of the company. Is the health is good or bad? So this is the end of our chapter 1. Please let me know if you have any questions. If you have any questions, please feel free to come either during my office hours or send me an email if you want me to solve a particular question, or you have any other question that you want me to create a video on it. I would be happy to do it. Again, thank you very much for watching this video, and I hope to see you in the next video.